In this video, Tom Lee from Fundstrat outlined his optimistic outlook on the current tariff situation, believing that markets should view recent developments positively despite existing volatility. Lee emphasized that rebounds in stock post-tariffs deadlines could booster CEO confidence and help avert economic downturns. Ultimately, Tom suggested that investing in U.S. companies remains a positive and promising opportunity for returns, regardless of government rhetoric.
For businesses, and I think it would set the stage for a much bigger recovery rally than we expect.
Afterwards, right?
Yes,
I mean,
after.
the problem is the paralysis, if you will, between now and then. Like, what are we supposed to do over the next 10 days?
I mean, that's the dilemma, right? Because we still have 8 trading days till April 2nd. Most investors are getting just nauseous from the volatility, so they want to throw in the towel. But we also know that markets will bottom or have historically bottomed before the event actually happens. You know, the best example is the Cuban Missile Crisis, 1962. That was a 12-day crisis. The stock market bottomed 7 days into that crisis, recovered 2/3 of the losses before the resolution. So I think that's a decent template for today.
What about the economy? I mean, listen to Nike, FedEx, put that on top of what we've already heard. Are you concerned about where the economy's going?
I mean, it's been pretty shocking how quickly sentiment deteriorated. I can understand for consumers because the president's very divisive, but for CEOs, that's been a shock. You know, CEO confidence has fallen, and they've kind of been sitting on their hands. So we know there's an impulse of a growth shock underway. But if this is something that doesn't last months, then it's very temporary.
I mean, it depends, you know, to what degree consumers remain skittish. CEOs are paralyzed in their own right because they can't really make any moves because they're not sure what's going to happen, and ultimately whether a growth scare spirals into something else, which Jeffrey Gundlach gave me his view yesterday right here on Closing Bell. Listen.
I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
50, 60%? I mean, if he's right, what does that mean for the stock market?
Well,
too expensive.
Well, the S&P had a 10% drawdown. That's already priced 40% chance of a recession. I'd say the markets aren't agreeing necessarily with his view because China, Europe, Canada, Mexico have been massively outperforming the U.S. since February 18th. Those economies should be tumbling into recession if we have punitive tariffs. So I think markets are actually more paralyzed than necessarily pessimistic. And
I'm sorry, finish your thought.
But because the market is the economy, I think to the extent that stocks rebound sharply after April 2, if they do, I think it really staves off future economic
Is the
weakness.
market the real economy?
I think it's these days, to me, I think it's a really good snapshot of actual sentiment and actually even CEO decisions. Because as you know, when stocks fall, companies lose confidence. And as stocks recover, CEOs gain confidence.
What about the idea that Gundlach also put forth that in his words, unintended consequences of all of the rhetoric from the president is making people think twice, especially overseas, about investing in the U.S., and the view that Europe is just a better value and offers even less risk than before? How do you play that?
I mean, we hear a lot of folks talking about that, but as you know, Europe tends to be single stock concentrated indices. So if you're buying Europe, you're basically buying industrials and financials. If you're buying Korea, you're buying Samsung. So I think if someone is looking for the best companies, they're still going to end up buying the U.S. You know, one of the things that we have to keep in mind is this trade deal, if it's acceptable, could actually basically sort of blunt this whole issue of trade in the future, and it would actually make the U.S. more attractive again.